Hello traders, welcome to my first video on chart patterns. So in today's video we'll be talking about the symmetrical triangle, and the reason I want to talk about chart patterns is many traders had asked me to talk about these because I haven't really talked about these at all yet. And these are very common, and you can find triangles in really any market. And the reason I'm just doing symmetrical today is I want to devote just one video in my series to just one pattern, so that we can talk about the psychology behind it, the math behind it, where to put stop losses and take profits, how to enter, how to exit, and all that, instead of just, going across like 10 different patterns, just telling you what they are, telling you how they behave, and then just ending the video. I think it's much better just to go deeper into one pattern. So yeah, today will be the symmetrical triangle. What is a symmetrical triangle? Well, a symmetrical triangle is a period where supply and demand are relatively equal, as you can see, and it's a resting period after expansion or contraction, as you can see here as well. And typically these are continuation patterns. So what that means is if the market's moving up, forms one of these, typically you'd expect the price to continue to rise. And for those who know Elliott wave theory, this is typically your wave 4. If wave 2 is a sharp zigzag down to the 0.618 or the 0.5, wave 4 will probably retrace around 38.2%, and A will be that 38.2% retracement. And for those who don't know wave theory, just forget that last 15 seconds and we'll move on. So that is what you get. You get a period of higher support and lower resistance as price contracts before it breaks out. Now, what's the psychology behind this? Why do these things form? And why can we say that we can trade them profitably? How they form is because many traders here at this initial resistance point are going to be taking profits from the market. And that's what's going to begin to make the market go down. And this point here is a point where demand for the asset begins to pick up. And then we get from A to B. B doesn't make it all the way to resistance. It really shouldn't, for this to be a symmetrical triangle. And the reason that is because, again, demand and supply are relatively equal. So demand for the asset, supply for the asset is not going to be high enough for it to form. Demand will not be high enough for the market to make it up to this level here. And supply will be stronger as other traders front run orders here. Many traders like to put their orders at resistance and support levels. And if many traders put their orders here, smarter traders will act before them and trade before price reverses. And that's what happens here. And this continues to happen as the market reacts to less volatility and less volume. For those who don't know, volume is just transactions of an asset within any time period. So, for example, 1 hour volume would be the amount of transactions that occurred. And transactions being shares of the asset, not transactions between a buyer and a seller. So if I buy 200 of something, that doesn't count as one transaction. That counts as 200, if that makes sense. How many shares of that asset are transacted? And volatility is just price change in a time period. That's all. So when you have very high volatility, you usually see very strong bull markets or very strong bear markets. And then you get this period of low volatility where price doesn't really know where it's going. Okay, so we talked about the psychology and how these symmetrical triangles form. Now let's move on to the statistics behind them. So the site I have here is the patternsite.com, and this is Thomas Bulkowski's site. For those who don't know who Thomas Bulkowski is, he was an investor who traded the stock market and was so profitable that he retired in his 30s. And the reason why we like his analysis a lot is not just his success, but also that he has studied the market more statistically than really many traders of his time, and compiled a lot of chart patterns and candlestick patterns that he put on the site for other traders to notice and to use to their advantage. So these numbers here are coming from the US equity market and nowhere else. So you can take these numbers really with a grain of salt. It's more important that you find the identification guidelines. But of course, as I said before, volume must be falling, meaning that as price contracts, you get that lowering resistance and that heightening support. Volume should be falling. And breakouts. So here it says that 3/4 of the time, you're going to get an upward breakout if you have a bullish continuation. If you have a bullish market that goes like this, it begins to contract, 75% of the time, you will get a continuation. And same thing for downward, except it's 73. So again, just think of these as continuation, but also possible reversals. Symmetrical triangle can be reversal around 25% of the time. Now let's look at an actual example. So here we have Bitcoin. And the reason I'm using TradingView is I had to go all the way back here because I really wanted to find a really good example for a symmetrical triangle, and CryptoWatch doesn't really offer that as well. So TradingView is a little bit easier for chart patterns than CryptoWatch is. So what we have here is a symmetrical triangle, and this looks like it is a bearish continuation. So we have the bears push price all the way down here, we get price goes up, and then we get this, and price begins to continue to fall. So what's going on here? Well, if we were to label this with using this right here, we can say that this is likely our, let me go back, that this is likely our point A, then we have B, and then we have C, D, and then E right here, and then E fails. And it has very tiny volume, as you can see right here. This volume is very, very small. And the reason that is, that's the D to E move, as you can see right here. D to E is very weak because that's when volume's falling and gets really, really tiny. That's the time when price is about to break out with a lot of volume and strength. And it did right here, as you can see. Volume being tiny, then we get a breakout, a continuation breakout with very high volume, as you can see right here. And you can also see that from this point all the way to here, you can see the volume is falling right here with a few outliers there. Volume is not doing too well, it's falling here as price contracts. So this is what you're going to see in a symmetrical triangle. There are a lot of ways to label them, different points for A, B, C, D, E, and that's important, but what the most important part isn't the labeling points, but what's most important is labeling these trend lines. You can label it here too, that's fine, and then waiting for price to break the trend line. So what you can see is if you identify a symmetrical triangle, and then you see this, and you draw trend lines, and you want to wait for a break of that trend line. Well, how do you trade these? There are two different ways you can trade into a symmetrical triangle. One is to buy, I'm going to be using the bullish example for this. Imagine this was bullish. One way you can use is to buy yourself into the market before it breaks out. This is a little bit more aggressive, but what you could do if you want to is if you see a ABCD pattern right here, you could use a Fibonacci retracement to enter into the market off of C or E. Probably C would be better, but that might be hard to do to label the symmetrical triangle that early. E is possible as well. And if you don't know what Fibonacci retracements are, I would recommend that you check those videos out on my site because those are very important if you want to get the leg up in trading symmetrical triangles. And the reason you would do this would be if you see a very bullish market and then you get on a 0.618 retracement and you buy yourself into the triangle and then put a stop loss right below point A. And then you get price to go up and you can take profit. Typically what traders like to do with triangles is the vertical range of the triangles, the price range. Typically what you see is that the breakout will be this amount of the price range, if that makes sense. You can look it up for more articles, but basically what that means is if the breakout's here, this wavelength will probably be the same as this wavelength as the highest range. That's one profit target you could use, or you could use also a larger Fibonacci on a larger degree. So that's one thing you can do, but that's not always easy and can be a little bit dangerous. Another thing you could do is, let's just imagine that you're shorting this market. What you can do is you can see that the symmetrical triangle has completed, And then you can short the minute that you see this high volume and high volatility as well. It has both. And you can short this market, and you can put your stop loss right above that top trend line if you're shorting it. If you're buying it, it'd be the flip side. You'd put it below the support trend line. So you'd probably want to put it somewhere in this vicinity and then target probably 2 or 3 to 1 risk reward, or more even, which would have been fantastic for this market. So that's going to be it for this video. We've talked about the psychology behind symmetrical triangles. We've talked about what they are, how they form, and we also talked about how to trade them when you recognize that you see a symmetrical triangle. I do still recommend that you label them. I'm going to go back to this. You do label them A, B, C, D, E. It's a really nice way to categorize your symmetrical triangle so that you know when a trend line break might be likely. And as always, you should always be looking at volume to confirm these price movements, because sometimes what you might see is something like this, where you think that price is going to break out of the trend line and you buy, but in reality there's really not that much volume, and then price does this to you. And that's why it's much safer to position yourself after a move has happened and then get not as much profit, but a higher chance of success. It's all in your preference, though. If you want to be very aggressive and get into like these points, or in this case, get into these points or get into these points to short or sell your asset, that's fine. But yeah, that's gonna be it. If you have any questions about symmetrical triangles, how they form, how they work, or any concerns on this video, just leave them in the comment section below. And if you would like me to do another chart pattern video and would like me to do a specific chart pattern, then leave that in the comments as well. Thanks for watching.